down at this stage. Harsha Upadhyaya is with us from Kotak Mutual Fund. Harsha, good to have you with us here on the program. As a stock market person, Harsha, how did you read the policy and the RBI policy that is? And I was wondering aloud, only wondering that maybe again from stocks was it a little, was the market left waiting for a little bit more? How did you feel?
Prashant, I think it was more or less expected given the tight liquidity situation that we are in. It was expected that there could be some measures around liquidity easing. And that's what we have seen. There is going to be additional 1.2 trillion liquidity that will be infused over the next few weeks. And that's definitely going to help our economy and also the banking sector, because the CRR cut will help them see slightly better net interest margins going forward in the next quarter. So overall, I think it's been more or less in line with the broad expectations that the market had. And that's why you have not seen any exaggerated market movements.
Harsha, and so you mentioned market. Just a quick word. Broader market is doing very well. I mean, it's really back in form. The small cap index that we were just sort of mentioning when we started, the small cap index is up 10% in the last fortnight. So things are in that sense back on track, or should we kind of read this in conjunction with maybe end of the year slightly, and we'll get the real show in the new year? Or do you think we're really back in that sense?
Prashant, at least I feel that it's too early to say that because the earnings numbers have not been so great in the previous quarter. And as we get into the result season in the beginning of the next calendar year, we'll have to keep a close eye on mid and small cap bucket, because that's where earnings have really seen a serious negative turn. And if that continues, probably we are in for higher volatility. But if that was just an aberration, then probably markets would consolidate and probably look at higher levels.
Harsha, any changes to your portfolio in the last 2 months post the Q2 earnings? I remember our last conversation, you said you brought down your weightage in autos because you were quite disappointed and valuations were high. What other changes have you made?
Not many changes, I would say, but clearly our portfolios have taken a little bit of a defensive tilt. We have increased a little bit of banking exposure in some of our funds. We have increased IT services exposure as well. So generally, I think the portfolio beta has gone down across most of our portfolios. And we have also been looking at most of these sectors from bottom-up perspective and seeing where there are likely disappointments, and we are kind of trying to trim those positions, or wherever the valuations are expensive, we are trying to trim those positions. But broadly, I would say we have turned a little cautious in the last couple of months.
And where have you trimmed your holdings?
Rima, I couldn't hear you.
You said you've also turned cautious and you've trimmed your holdings in certain sectors where the growth outlook is patchy or valuations are high. Do you want to tell us where you've brought down your holding?
Nothing much in terms of sectoral trends. One which you also mentioned earlier in the show, that's about cutting some exposure in auto and auto components, more because of the huge performance that we have seen over the last few quarters, and the fact that probably next 1 or 2 quarters may not be all that great for all the subsegments of auto. There are still some pockets which are continuing to do well. From that perspective, we have taken some money out of this basket. However, now, after the correction that we have seen over the last 2 months or so, the valuations have come off quite a bit. So I don't think there is further action required on this front. As far as industrials are concerned, that's another segment where we have booked some profits over the last couple of months. More because of the valuation richness rather than any earnings slowdown that we are witnessing in any of those pockets. However, we'll keep an eye on the January result season and then probably take further calls on our portfolio. That's what we'll probably do.
Harsha, what about the beaten down, bombed out names within financials, the private banks, etc.? I mean, that of course is our consensus kind of overweights, and there's valuation comfort, etc. I'm talking about the lesser talked about names in the NBFC, even MFI. spaces. I mean, if these spaces do go through, they're more cyclical as compared to banks, which are steadier in that sense. Do you think it's time to start looking at some of them? Have you done so?
No, Prashant. At this point of time, we are sticking to large private sector banks and large public sector banks. MFI is something that we don't hold in most of our portfolios. We turned negative on that segment quite early, and thankfully, we didn't have any exposure in recent times when the sector has witnessed a lot of downturn. Similarly, the other pockets where there are certain regulatory concerns at this point of time, for example, life insurance is also something where we do not have a very large exposure. So clearly within banking and financials, most of the weight is coming in banks, especially large banks.
The entire financial space. What about exchanges? Actually, MCX is the big mover. We talk about BSE, but MCX is up 7%. And maybe a little cleaner, sort of more dominant position there. Any thoughts here?
Prashant, we clearly see that the penetration levels that we are seeing in the capital markets is likely to increase, which is going to be good for all the entities which have incomes coming from capital market related operations. So stock exchanges, wealth management firms, asset management firms. These are all part of our various portfolios at this point of time. On that entire basket, we continue to remain quite constructive.
So Harsha, on platform companies, the likes of Zomato, Swiggy, etc., we always knew the opportunity was there, growth is there. And now over the last few months or quarters, we've seen that they're ticking the box or improving the profitability. So that may not be a big concern going forward. But now the problem is valuations. Valuations are very high. So what is your call on these platform companies, new age tech companies?
We have been positive on quick commerce as a segment within the new age businesses. And clearly, we were one of the early ones in terms of picking this particular space. And we continue to hold on to them. Yes, the valuations have moved up, but as have been the kind of delivery that we have seen in terms of the earnings trajectory. So we continue to remain very, very positive on this space and continue to hold the positions.
To buy even at these levels, quick commerce companies?
Quick commerce is something that we have been positive on, as I said.
Okay, all right, Harsha, we'll leave it there. Thank you very much for joining us. It's a pleasure having you here on CNBC-TV18 this afternoon. Appreciate it.
For more news and updates, all you need to do is follow CNBC-TV18 on all of our digital platforms.